literally the first of its kind, and it's the only game in town right now in the mergers and acquisitions space. And this is called Transaction Liability Private Enterprise, or TLPE. What this is this is a reps and warranties insurance product, and it's designed specifically for the micro market. Now, two things here for those of you that may be new to this and don't specialize in mergers and acquisitions. We'll get into what reps and warranties is. However, if you want an in-depth conversation about reps and warranties insurance as a product from beginning to end, we have a prior webinar on that. What we're going to address is how this powerful tool has now been harnessed and brought down to the micro market. Now, let's put in context what micro market is. Okay, you've got your mega caps, which are your Googles and Amazons. You've got large cap companies, small cap companies that are in the public sector. You got middle market companies, which could be anywhere from $1 billion down to $100 million. You have the lower middle market companies that are between 100 and 500 million, so there's a little overlap there. And then you got the micro market, and that goes all the way down to companies that have an enterprise value or purchase price of $15 million or less. And that's the area we're going to talk about today, because this area not only is vibrant, it's essentially an economy, but it is a massive market. Okay, you could have the greatest product in the world, but if you don't have very many targets to go after, it's not a very viable option for you. So let's talk about that. Before we get into all things TLPE, real quick, brief introduction for your speaker here. My name is Patrick Stroth. I'm a native San Franciscan, which if you're born and raised in San Francisco, you're obligated to tell everybody about it. So we just checked off that box. I've been in the insurance industry for 30 years. And one of the things I can say about it is that every now and then you're going to see a new product being innovated in insurance that you look and it's like, conceptually, that's a good idea. And this could be big. Examples I had are when employment practices first started, and now cyber liability. You couldn't get anybody to pay attention to cyber liability. Now it's front and center with everybody. We believe sincerely that TLPE is the same type of thing. I'm based in Silicon Valley, which culturally within Silicon Valley, if you ever saw the TV series on HBO, exiting a company is embedded within the culture of Silicon Valley. You don't build a company to pass it on to your kids. Your goal is you're working for a major company. You've got a side project out there that you hope eventually you'll launch as your own company, and you're going to sell it for 8 or 9 figures within 5 years. That is throughout the entire culture here. So you look at businesses a little bit differently when you're thinking about the end. My mission out here, why I'm pushing, why I pivoted our practice to mergers and acquisitions is, quite frankly, I feel this is the most exciting event in business, okay? There's nothing else in business that provides not only life-changing, but potentially generational changing liquidity events for owners and founders, okay? And if there's any way that I can make these life-changing events, and change is a real scary thing, but if I can make these life-changing events faster, cheaper, and happier for the people, who wouldn't want to do that? And that's why I'm very passionate. I really believe in these types of products, both in the rep and warranty, and now as we come down to TLPE. So let's talk about TLPE. First of all, as a rep and warranty product, okay, the analogy we usually use on this when you're dealing with sellers of companies, they're selling their company to buyers of companies, okay, the analogy we usually use is you're going to go ahead and sell your house. And as a seller, you put a list of disclosures about your house. Okay, these are called the reps and warranties, which are everything from the roof condition, we've got electrical is up to speed, plumbing is up to speed. And if you come from San Francisco, we've got a lot of older houses where people were building in-law units or decks out the back of their house to enhance the value and enjoy living there. But a lot of people don't realize that, there were a lot of contractors in San Francisco that would help you on the cheap put in an in-law unit for a relative moving in or for the kids, and they weren't quite up to code. And you go and you put it in and you're under the radar and nothing happens. And then you go 10 years later, you completely forget about that in-law. It's just part of the house. And then you go to sell it and the buyer comes in and they pick it up. And even though they do a house inspection, they may not have checked to see if that little addition is legal or not, it was up to code. And then that buyer, a year after buying the house, decides they want to upgrade that in-law unit, make it a home office or whatever. And then they find out from the city or from their contractor that, wait a minute, this is illegal. This is going to cost 100,000 or more to get it up to code and get you back in compliance. Well, you know what that buyer's going to do? They're going to look at the contract where you represented that everything was fine, and they're going to come after you. That's the exact same thing that happens in businesses. Within a purchase and sale agreement, the buyer has a right through the clause called the indemnification clause to claw back some or all of the purchase price post deal for something that happened that the seller had no idea about. So if you go ahead and you sell your company, you're not getting all that money in your pocket. It goes to pay off loans, it goes to pay taxes and everything. So you may not have everything. But then what happens when your buyer comes back for something that happened out of the blue? This is the exposure that's out there. On larger deals, $100 million plus, they have a product called Reps and Warranties that covers that exposure. It has not been available for the lower middle market until very recently. And then still the micro market, it hasn't been available until today. And so that's what we have. Now, I'm more of a visual guy, so let's just take a look at what this looks like. We're going to take a typical deal right now. We've got a $10 million purchase price. The indemnity cap, this is the amount of clawback that the buyer can do within the contract. They can come back, particularly for a breach of the fundamental reps, and get their money back in total, okay? And whatever you don't have from the funds, they're going to bleed you for that. So that's an exposure out there. It's standard within this micro market that buyers are going to retain. They're going to hold back about 10% of the purchase price, just so there's a pot of money there for funds that are available. So if some breach happens, they can mitigate and throw money at it real quick and make a $200,000 claim, not a $400,000 claim, because they can put money at it. So what the seller gets, best case scenario, is they're going to get $9 million at closing, provided nothing happens to them in a year or two after a year or two after the close. If nothing happens, they'll get that $1 million back. But they don't have control over that, so they wait. So that's what we have in a non-insured off. Okay. Now with TLPE, here's what we can do. We can go ahead and instead of having a $10 million indemnity cap, we can replace that with a policy that insures up to the full transaction value, which is up to $10 million. Okay, so that in the event there's a breach and the buyer has a loss, they're not going to get money from the seller, they're going to get money from the insurance policy. These policies are subject to a 1% of transaction value deductible. Okay, so in this case, it would be a $100,000 deductible. From there, the policy attaches. Now, if the policy is going to step in after 100,000, why on earth does a buyer need to retain any more than that $100,000 retention? Therefore, under this scenario, the seller gets $9.9 million at closing. That's $900,000. That's a lot of extra money there at closing they get. Even better, they have peace of mind, because not only do they get that money at closing, they get to keep it, okay? Because here's the thing, your downside, if you look at the left-hand column, your downside on the indemnity cap, the maximum loss is $10 million. Okay, you're out $1 million, okay, but you could be out $10 million. Under TLP, the worst case scenario is you lose that $100,000, okay, on the deductible. That's a 1% versus 100% loss, okay? Cost on this, we'll get into the cost a little bit later, but that's between $100,000 and $200,000 is the range for the cost on this, okay? So for 1 to 2% of the purchase price, you're gonna have protection all the way up to the total purchase price, okay? This is as we do these side-by-sides with a lot of attorneys as they're looking at this, they describe it consistently as a no-brainer. So let's talk about the nuts and bolts of a TLPE policy. First of all, it's called a sell-side policy, okay? Contrary to traditional rep and warranty policies where the buyer is the insured, buyer suffers a loss, buyer then goes and the insurance company gets paid. Seller has an exit entirely. In this case, the seller is the policy holder. So it protects the seller and under this with a sell-side policy, okay? So it's written to cover claims brought against the seller for, what we call innocent misrepresentations made by the seller to the buyer. There are a lot of things in your business that you may not be aware of out there that could come to roost post-closing. And why should you be held responsible for something you didn't know about? Okay. The way the policy is triggered, where coverage comes in, is when the buyer brings a written demand to the seller saying, this happened, we suffered this financial loss, pay me. Policy gets kicked into action. Seller reports this to the underwriters, and the process goes forward. Okay. The policy, what does it cover? It covers the legal defense costs, settlements, and contractual damages. Now, why defense costs? Well, if the buyer comes to you demanding $1 million or $10 million, you're not just going to respond. You're going to have to bring an attorney in to respond to their demand and negotiate on your behalf. Well, that costs money. That lawyer's cost is provided by this policy. And if the two sides agree to settle to cover the buyer's loss, expedite this thing, that gets paid. And then contractual damages, this is interesting because, and we'll get into a little bit more depth later, but when you have a breach, that is a breach of the purchase and sale agreement. That's contractual breach. Contractual breaches or contractual damages are excluded on most policies. They are specifically included here because that's the intent of the policy. What's new about this product now is, just as you have when you buy your Ferrari out there, a lot of people don't pay for the Ferrari in full. They may have a bank or a lender behind it. And then a Ferrari gets smashed and totaled. Well, the lender or the loss payee gets paid first. In this case, with buying businesses, there is a new provision in TLPE that once a settlement has been agreed and a dollar amount has been figured out, the insurer will go ahead and direct the payment to the buyer directly. Okay, the buyer doesn't have to wait for the seller to collect the funds, sit on them, and then pay the buyer eventually. So this is a direct payment. This makes the buyer, while not a named insured, a stakeholder in the policy. So it's very much in the buyer's interest to be open to have this in place for their deals. In my experience with insurance, it's not what's covered that's important, it's what's not covered. So let's talk about the types of exclusions that are typical here. Okay. First of all, if there are any known or disclosed matters, if you know you've got some lawsuit out there or you've got a human resources issue out there and everybody knows about it, that's obviously not going to be covered. Okay. When we talk about tax relief, if you are counting on some kind of favorable tax treatment or some tax benefit that you're due for whatever reason, they are not going to insure that. Let's qualify that. If you represent that you have paid your taxes, including sales taxes and so forth, and the buyer has looked at that, and later it comes out that your taxes weren't exactly accurate, this policy can step in and provide defense. So there are issues where taxes can be covered. A common thing with smaller companies is they don't have their financials audited. However, within the agreement, they warrant to the buyer that, oh, well, I mean, they're not audited, but they're at GAAP standards, so we're in accordance with GAAP. Well, you can't be in accordance with GAAP if you've never been audited, so that's a problem. So if you are making that representation, that is a limitation. Coverage won't cover that. When we talk about condition of assets, if you're selling your business and you've got equipment and inventory and so forth, the policy is not going to step in and cover the quality or the value of that of those assets, okay, which is a common thing. Recently, we've had the PPP loans and the SBA small business loans and all these things in the wake of the pandemic. Compliance on those, the policy will not cover that type of thing, which is pretty much standard throughout most rep and warranty policies. I threw in 10b5. These are catch-all reps that will be put in. They are becoming less common, but they are out there where, in addition to all the itemized things, in case we forgot to ask anything, you don't know about anything else that could be there. Okay, those are very broad catching things that are no longer going to be allowed. They're not in the rep and warranty area, and they're not here with TLPE. And then finally, if there are exposures such as cyber or environmental or specific tax issue, there are policies for that. Those policies in many cases can be broader coverage, and in some cases cheaper than the TLPE, although TLPE is very affordable, but there are specific exposures that are best covered elsewhere. So they just excluded here so that you're not paying for duplication coverage. Two of the three most common questions I get, and these are the first two: what's it cost and who pays it? Okay. Unlike most other policies, I'm very happy that we've got a lot of transparency. We can tell you, okay, how these things are priced and everything. First of all, the policies are priced based not on the exposure of the risk necessarily, but how much insurance you buy. Okay. So what we have here is you can budget back at the envelope right now. The cost is between $10,000 and $20,000 per $1 million of coverage, which is why in the table, we'll revisit it later, $10 million policy can cost between 100 and 200 grand for a number of factors. This is subject to a minimum premium of $15,000. So if you have a $2 million deal, which we can insure, and you can insure for $1 million, you only want $1 million in coverage, 15 grand, no problem. We'd recommend insuring to the full purchase price when you're at that level, but this is what you have. The more limits you purchase, the lower the rate will go. So that's one thing to keep in mind on this. So if you've got a $10 million deal, and we will see deals that are $12, $13 million sometimes, and they only want $2 million in coverage, you're going to be at the higher, closer to 20,000 per mil rate. The more you buy, the lower the rate goes. Contrary to traditional rep and warranty, if you're familiar with that, the policies are not limited in cost to just the premium. There's a separate underwriting fee that gets incurred. Again, those are buyer policies. The underwriters are underwriting the buyer's diligence, not the quality of the risk, but the buyer's diligence. That involves retaining outside counsel, which is running $30,000 to $50,000. Okay, that is not needed here, so that's another savings. Now, who pays? Well, the policyholder is the seller. So in many cases, you can default and just say, well, the seller is going to have to carry this. It benefits the seller. However, now with the loss payee provision in there, it's in the buyer's interest to make sure that the seller gets this. So it is very common, as it is with traditional rep and warranty, where the buyer and the seller split it 50-50. Real simple. Okay. At the very least, if the buyer is aware of this policy being secured and quoted, why not negotiate and have that withhold or that escrow amount lowered to match the policy retention? I mean, that's favorable to the seller, and it's at no cost to the buyer, which is, a nice, elegant way to go through these negotiations. So what's the process? How long does it take? What's involved and so forth? Because again, with mergers and acquisitions, and with anything in life, whenever you have some new process or new business practice or new system, doing it the first or second time is always a challenge. Okay, I can tell you right now, as you'll see, TLPE is a fairly easy type, low maintenance type process here. So it starts with this. We have an application that gets filled out. The risk is evaluated based on the standard industrial classification code that the industry is in. We need current financial statements and a copy of the letter of intent. If you've got a draft purchase agreement, even better. But having the letter of intent, the financial statements, along with the application, which is only about 5 or 6 pages. I mean, cyber liability policies are more invasive. That's how you can get that over to us. Okay. The underwriting process, this is built for volume. It is built for fast processing. So when we get these submissions in, we can turn around a written indication within 2 days of receipt. I'm tempering underwriters' enthusiasm. They're saying 1 day. Let's give it 2. But you can have this in 2 days. So those of you that have deals, even if they're coming up closing scheduled for March 15th, we can do something. Now, when the underwriters get the application, there may be a couple of extra questions they have. They will need those answered in order to finalize terms. It's rare, but a lot of times there are some extra moving parts we just want to make sure, so we don't have to impose any problematic exclusions or so forth. Once we get the response, the draft policy is ready within a day. So you have a document that can be added to your closing document package and schedule, and it's all taken care of. So again, beginning to end, this can take 2 to 3 days, and you have a document ready for closing. The way the policy takes effect, the policy does not take effect until the deal closes. So if the deal's delayed or the deal gets tabled for some reason, there's no coverage in effect, there's no cost involved, it's there. The premium is paid at closing in full. It is not subject to any refund. So it is just like a tail policy or anything else. The premiums are fully earned. But again, this is a very quick, smooth turnaround. I would say for any of the insurance brokers in my audience today, This is ideal because you're not chasing clients for payment plans or installments or anything. It is paid 100% upfront and done. So who's eligible for this? What's the appetite for the underwriters on this product? Again, this is the only market with the only product of this kind out there. So they can be a little selective. Okay, but be aware. They are looking for companies, these are target companies with an enterprise or purchase price between $500,000 and $15 million. Will they look at something that's a little higher than 15? Sure, they will. The maximum limit they're going to offer is 10 million in limits, but the risk factor for this industry or this class of business goes up precipitously as you go above $15, $20 million in the threshold. That's why they want to stay down here for the time being. Okay. What type of businesses? Well, think Main Street businesses, your BOP policies, things like that. Okay, we're talking about firms in the hospitality, retail, franchises, leisure manufacturing, and the real estate sectors. Yes, real estate is eligible for this. Think about, we got plumbers, HVAC contractors, there are landscaping, funeral homes, caterers, all these types of organizations would fit. It's just anything you would see down Main Street, USA. They will consider companies that are providing professional services, billing, advisory, those types of things. Technology companies love SaaS. The first policy in this program was a SaaS company. They are eating those up like crazy. If there are product businesses, consumer products and so forth, they can handle that, transport, aviation, and yes, insurance brokers. If you look, again, for the brokers in the audience, a lot of insurance firms aren't growing by selling more policies. They're buying agencies and brokerages. Okay, this product can be there for just those types of deals. Ordinarily, what the facility doesn't like is anything that's heavily regulated or exposed to a real severe loss. Okay, so you've got everything in the healthcare, financial services. You see the energy section, aerospace, things like that can be problematic. However, let's caution that if you have a business that provides services to these particular industries, they may still be considered. So worst case scenario, send us send me a note, ask me about the deal you have, and we'll run it by them. I want to share with you a case study on how TLPE literally took a deal that was dead and got it closed within a week. Okay. There was a Texas-based SaaS company. They specialize in human resources for employers, and they're going to be sold, small deal, 5.5 million. Okay. The buyer, who happened to be Axel KKR, major capital company, was out there. They owned the company that was buying the SaaS company. Okay. Within the documents, within the agreement, they said, well, you're a technology company. If there's an intellectual property breach, we retain exclusive control on the legal defense. So we will use our attorneys. Okay. What the seller decided from that wording, the way they interpreted it is, well, you're going to have your $1,000 an hour attorneys out there, and they can go and drag out the bills, and you can burn through the whole $5.5 million that we're on. We're not going to underwrite that, no. And so the deal died right there. The seller, with the deal now off the rails, reached out to Rubicon and he explained the situation and said, is there anything we can do about this? And we ran this by underwriters, and absolutely we did. We put together a policy for this founder and his partner for $5.5 million that contained the provision, if the buyer incurred a loss, including those defense costs, the legal cost to fight the IP, and it went up to the purchase price of 5.5 million, policy would go ahead and do it. Okay, so we insured that target up to the full transaction value. Okay, so the deal went from dead, or as they said in The Princess Bride, well, he's not all dead, he's just mostly dead. And we brought it back. As a matter of fact, once the parties agreed to this, it went forward. It was done in less than a week. Actually, the holdup on this was more the bankers having to redraw the documents. So this is a case where a lot of these small deals can fall off the rails, and here's a way to keep that from happening. One of the the third most common of the questions I get, okay, you got who pays, what's it cost? Do they actually pay claims? Okay, TLPE as a program has only been around since July 2021, so there hasn't been a lot of time for claims. But we do have a case study right now. And it's one where we had a seller of a Mexican restaurant, a small chain of Mexican restaurants, And what they failed to disclose to the buyer is that a lot of their equipment there were a lot of equipment leases. They forgot to tell them, they kind of implied that they owned all the equipment. Well, that resulted about $50,000 in damages. You know, the underwriters went, claim was reported, they investigated the matter, saw that, you know, this was an honest mistake, settled with the buyer, and it was all paid within 6 months. Same client, boy, I'm glad we didn't have this one, but same client later found out that they had missed some, you know, employment rules and so forth. And so the Texas Workforce Commission, or TWC, looked into them and found out that prior to acquisition, they had incurred a bunch of violations for a number of hours for underage employees working. And so it resulted in a $409,000 fines and penalties case brought against now the new owner who assumed the risk. Okay. CFC is the underwriter on this. They provided the legal defense counsel to come in and argue with the TWC on behalf of the buyer. They settled and paid the settlement. So, I mean, again, it's a great resource when the insurance company not only is going to pay a claim or reimburse you for your expenses, they're going to bring an attorney in for you. So you don't have to pay the attorney and then wait for reimbursement. They take care of that for you, subject to the deductible. So again, these are the things, as I said, when you build a house and you've got something that may or may not be to code and years go by, you forget. These are honest oversights that happen all the time, particularly for smaller businesses, because the owners and founders have 1,000 things they're thinking about every day, and they may not have remembered some of these things. Let's talk about the biggest benefit that you have with rep and warranty. And I include this picture because I'll tell you, if you're a seller of a company that's valued at 15 million and under, you got to consider your buyer is 100 or 1,000 times your size. And so you don't have a lot of negotiation or a lot of leverage out there. Okay. And they know it. And so sometimes as you get into the negotiations, you might be feeling like you're about to get stomped. Okay. Well, with the rep and warranty policy with TLPC, you're going to avoid a lot of contentious negotiations because there's a lot of fight over this, particularly with the indemnification agreement, that clawback provision that the buyer is going to insist on. And a lot of times there's an issue here where you can have a lot of misunderstandings as negotiations get going, because I mean, it's hot. We're talking about money. We're talking about life-changing events. It's a very risky time for sellers. And the sellers, through no fault of their own, they're not experienced in this. I mean, how many times are you selling your business? Okay, the buyers are experienced. They know how these things work. They've done, scores, if not hundreds of these deals. Okay, and what they understand this market, you may not. And so that gets a bit scary. And so having something that can level the playing field, you can't put a price on that. And again, the biggest issue is with indemnification. That's that clawback, that money back guarantee. And what happens is the buyers are going to go ahead and they're going to put the sellers through, a real rigorous diligence process. And then the buyers say, look, I know there's probably nothing that's going to happen. We love you. We can't wait to have you as part of our team. But I'll tell you what, in the case something happens, we need to be able to claw back all the money. Okay, we don't think that's going to happen. Well, what the sellers hear is the sellers are kind of like, wait, I just disclosed all this information. I bared my soul. And you can still, if you miss something that wasn't my fault, you can claw all the money back. Also, that creates distrust. By having something in place that protects the seller's interest, all of a sudden, these fears are abated. And I mean, the weight on it, one of my clients just said the amount of mileage on my soul by getting a policy like this, I couldn't put a price on. Okay. And in cases where you've got a buyer that is acquiring a company and maybe the owner founder is joining that company, as happens in a lot of insurance firms where those founders come and now they're part of the larger company. Okay. Post closing, if something blows up, that gets real uncomfortable for the buyer who now has this great rock star or rock stars on their team going to them and saying, yeah, we gotta get some money back from you because of this. If there's an insurance policy in place, that conflict is gone. Okay. And so these are the wonderful things. These are the side benefits that just, I hate to be redundant, but you can't put a price on the wear and tear that is eliminated by the presence of this policy. So why TLPE? I mean, again, this is a new product. Is it just the insurance people coming up with something new to put on the public? Well, let's take a look at this. Okay, first of all, there are no rep and warranty policies out there, with very few exceptions, that will write a policy on a sub $10 million deal, okay, for a number of reasons. First of all, it's cost prohibitive. Buyers don't want to pay $150,000 minimum premium plus a $30,000 to $40,000 underwriting fee, so they're not going to do it. Those policies require extensive diligence. They don't want to go and pay those expenses. They know that. And a lot of times, again, when you see how many opportunities are out there, the insurance community in the rep and warranty market, they've got too many 500 million to billion to multi-billion dollar deals that they're looking at. They don't have time for these smaller things. Okay. The loss provision right now for the payee, which is new, that benefits both sides. How many times do you have a policy that's going to be out there that has both the buyer and the seller's interest in heart? The TLP, in a lot of, when you can't get a rep and warranty policy, a lot of buyers require sellers to secure what we call a 6-year D&O tail policy. Okay, even though they've never had D&O before, they'll require to carry a D&O tail policy. That D&O tail policy contains a contractual liability exclusion front and center. So it's a little bit awkward if you do have a tail policy where the buyer claim comes in, they're going to have to allege fraud. Okay, they can't say, well, there's a breach of contract because that's excluded. Okay, TLPE is specifically written to cover that. So what a seller could do is go to the buyer and say, you know what, we have an alternative. Why don't we get this TLPE instead of the D&O tail? You can get higher limits for a lower cost than is available in the D&O market, which is a nice alternative out there. And again, this is the one product that's going to address the biggest need out there. And this, for sellers, it's fear of catastrophic loss. Okay. And there have been a number of issues. We've had one where, when we talk about, do you own your shares? Are you allowed to sell your shares? Well, what happens if there happens to be a divorce with the owner and founder and his or her spouse from years ago? And, you know, it isn't until after closing we find out that the former spouse had some shares, or a relative, you know, in a family business had some shares and wasn't consulted. There are those types of things that just aren't tracked when you've got small things out there. Okay, so I want to return now. So again, this is the only game in town that's available. And let me give you just a real quick idea how large this market is. I have been mentioning, but let me give you some numbers. Okay, in the middle market, these are the $500 million to multi-billion dollar transactions. In that realm right now, there are over 2,500 of those transactions happening every quarter. Okay, a lot of people, when they think M&A, they think Amazon and Whole Foods. There are a lot of small ones you've never heard of that are like billion-dollar companies. So they have that many happening at that level. Okay, when you think about these sub $15 million deals, okay, there's 100 times more transactions a year in those than there are in one quarter. There are about 250,000 of these transactions happening annually. Okay, when you think about the number of baby boomers, 30 to 40 million of them, many of them are owners of businesses themselves, and they're reaching the time where they're going to be thinking about an exit. It is out there for you. And so it is huge for, you know, the need out there in the marketplace cannot be any larger than it is now. I want to return to this to remind you on the slide here about, you know, mitigating downside. Okay. And again, in a lot of cases, you're going to have between $100,000 and $150,000 where you can tell an owner and founder, you get to keep your money, you get to sleep at night. You do not have to worry about losing your entire nest egg now. We have this product that will protect you. I would say for the insurance brokers out there in the audience, if you want a conversation starter, even with a non-client, you know, when you're asking them, you know, what are your plans for exit? What do you see down the road? Okay, you get a lot of people. It's very interesting. A lot of people smile when they start thinking about, you know, golf, the beach, that second house, seeing the grandkids, time to themselves and everything. And then they start thinking and looking about that. And what's great is they may have great, and they may be you, but they may have great insurance agents and brokers covering their needs and taking care of everything. But those brokers are really good, but they don't know about this product because they're not in mergers and acquisitions. And so I would really recommend starting a conversation with people like this, because this is new. And particularly if this isn't an existing policyholder of yours, there's zero conflict. You're not asking them for their interest. You're talking to them about their dreams. And that's going to set you apart from a lot of the other people out there that they talk to every day. And if, as I mentioned, we can turn and burn on these very, very quickly. And I would welcome any of you, if you have a deal out there, if you've got a client out there, you want, what we call a strategy assessment for this, we can talk about conversation starters or ballpark pricing and, the ins and outs of the process on your next deal. We're coming up on the end of the quarter real quick. There are a lot of merger and acquisition transactions that are on the table right now to be closing by April 1 or March 31. And we are absolutely ready for that. Just reach out to me and then we'll get you taken care of. And I'm going to turn it over to Tanya here.
Thank you so much, Patrick. As a reminder to our audience, please feel free to submit any questions that you have. Patrick, we do have one question from the audience here, and they're asking if this is available to initial purchase of a franchise from a franchisor.
Absolutely, yes. That's one of the desirable thing franchises, yes.
Great, that's good to know. And then a couple of other questions we have here. Is $15 million the max deal size that is eligible? What if it's like 18 or 19 million?
Yeah, if anything from 20 million and down, it doesn't hurt to ask. Like I said, we're capped at 10 million. I think once you get over $20 million, all of a sudden the risk becomes a little bit more hazardous for underwriters. They don't want to entertain that. They want to stay down below. So it never hurts to ask. So you got 17, 18 million. And you want to buy $5 to $8 million in coverage, 50%, fine. Please bring them.
Great. And then what if the buyer won't lower the escrow? How can this policy help?
So if the buyer doesn't lower the escrow, unfortunately, there are some buyers that are going to dig their heels in. They're going to say, hey, absolutely, we're not going to release the escrow. You're going to have to kind of swallow that, and you're going to have some of your funds held in the escrow. The nice thing is that, again, with the loss payee provision, in the event there is a loss and the buyer goes ahead and starts using the funds from the escrow to pay the damages, well, the insurance company is going to go refill that escrow, because the loss payee, they'll just go and send the payment right to the buyer. So even though you got the escrow, you're sure that you're actually going to get a return of it. You just have to wait a little while.
Okay, good to know. And then are there any other carriers that are doing this right now?
Yeah, just like employment practices back in the early 90s, just like cyber liability, the product started with one carrier brave enough and innovative enough to start it, and is a copycat league, and there will be more people, more carriers coming into the market. It happened with rep and warranty, it happened with cyber, it happened with EPL. As of today, the underwriting facility, CFC out of London, is the only game in town for this.
Okay, great. And then one last question here. What determines the premium rate? What factors into the lower side versus the higher side of the premium?
First and foremost, the more limits you buy, the less premium per limit will be charged. So if you're going to be buying 10 million in limits, you're largely going to be closer to the 10,000 per mil rate. However, if you're in a higher risk classification, I had mentioned those medium risks, some of the technology companies, service providers, things like that aren't exactly Main Street, but they're providing professional services or light manufacturing. Sometimes depends on what's being manufactured. That's the type of thing. It's determined a lot by the SIC code.
Okay, great. And then we actually have one more question from our audience. So they're asking that they have a seller that does not want an escrow. This would be an answer for the seller to the buyer, for the seller to buy this insurance.
Absolutely. I mean, this is the ideal spot where the seller doesn't want any skin in the game whatsoever. Is called a non-indemnity kind of provision. And so what this policy will do is it gives the seller the resource to go to the buyer and negotiate, saying, we don't want an escrow. We have an insurance policy. Oh, And buyer, you are a loss payee on the policy. So if there is a loss and it's settled, the money goes to you directly. Don't pass go. Don't collect $200. The money's going to go right to you. So that is the way the negotiation can be set up. Absolutely. There's still the retention. So the policy retention is going to be there. How that gets funded, they can wait until a claim happens. They don't necessarily have to fund it. They can figure out some other mechanism. But this is the tool where the seller can go to the buyer and say, I have a resource for you. We can move forward.
Okay, great. Well, thank you to all of our audience members who asked those great questions. And please note that I'll be following up with a recording of this presentation along with some flyers that Patrick wants to share with the audience. So thank you all so much for joining TLPE Solutions for the Micromarket M&A with Patrick. And Patrick, do you have any final words for our audience?
Yeah, I'm putting my contact information up here because again, for the brokers in the audience, and maybe if there are any M&A attorneys that are listening in here, we are, if you want to copy the application and the policy wording, we'll get it out same day. Just shoot me an email. My contact number information is there. Reach out to me. We will get those out to you.
Sounds good. Thank you so much, Patrick. And thank you to our audience for your time and for joining us today. I will be sending a follow-up soon. So if you have any questions, please feel free to reach out to myself or Patrick.
All right.
All right. Take care, everyone.
Good morning, everybody. Peace.